Okay, Graham, shall we go? Shall
Let's do
we?
it.
Let's go for it. Okay. Right. Good morning, everybody. Just for everybody's knowledge, I'm Clive Brady. I'm the chairman of the BWA. So welcome this morning to this post-EU exit VAT webinar with the focus, I think, as Graham has already circulated, very much focused here on the VAT aspects of the implications around VAT following the EU exit. Just before I go on, for everybody's kind of experience or better experience, can I, other than the speakers, can I ask for everybody's mics to be muted so we get as little background noise as possible? That'd be really good. And then obviously, as we go through, you have the chat facility to raise questions into Graham for our Q&A session. And when we get to the Q&A session, obviously you've got the you can hold your hand up functionality should you wish to pose a question. So I think that's the housekeeping out of the way, isn't it, Graham? Is there anything else to mention other than the fact that we are recording the webinar today?
Yes.
Yeah. Okay. So as I say, welcome everybody, and thank you for your time on this Thursday morning. Focus today with our colleagues from HMRC and friends from HMRC and NBCC from across the water is to focus on VAT. So we have Mojgan from the VAT Fraud and Transition Readiness team who's going to speak around, obviously the VAT at the border, the UK border, so imports primarily, importation, and the VAT requirements there, and possible impacts around non-deductibility, etc. And also through special customs procedures such as customs warehousing we'll touch on, as well as through the excise warehouse regime, the VAT implications of that, and also very much a topical conversation at the Northern Ireland and the Northern Ireland Protocol and the VAT changes and potential implications as regards to that. We also have Andy Spencer, who's Director of Professional Service from Sovos, who is representing NBCC today, and we'll talk around, I think, more around practical aspects, correct me if I'm wrong, Andy, and that some of the NBCC members have seen when importing or exporting, from the EU into the UK. So I think just to make sure we keep on track, that's the intro from me. So Mojgan, if we can hand over to you, that'd be great. And as I say, anybody has any questions, rather than interrupting Mojgan as we go, we can raise those questions and Graham can capture those and we can deal with them. If you're comfortable with that, Mojgan, as we, kind of towards the back end or towards the end of your presentation.
Thank you very much, and I hope everyone can see my screen.
Well, I think we can, yes. Yeah.
Fantastic, great. Good morning, everyone. So my name is Mishka Ahmed. I work with HMRC's VAT and Indirect Tax Directorate. This morning, I'm joined by a number of colleagues from across the board, both for customs and VAT. Reason is VAT is a reactive tax, so we felt it necessary to cover elements of customs before we really jump into the deep end and cover all of the issues relating to post-transition VAT, both in accessing the Great British markets as well as the Northern Irish markets. So without further delay, I'll hand over to my colleague David, who will take us through the first element of this presentation, which will cover the customs element. So over to you, David.
Great, cheers, my friend. So yeah, as has already been covered, thought it's probably good to go through some of this just to kind of set the context of all the VAT things that you'll hear after this. So lots of this will probably not be new to you. It's probably stuff you've already heard, but with so much new information out there at the moment, always worth to try and keep it in mind in the relevant context, because there are various changes happening at various points. So just to kind of be really clear on where we are and when we're at certain points. So as again, you probably all know, we've been introducing our border controls in stages. So this did start at the beginning of this year, but will be this is kind of during staged customs controls it's being referred to, but we will then be moving to full customs controls from the 1st of January next year. So that's kind of the big date on the horizon, kind of coming up worryingly quickly at times. So even from January, import declarations have been needed, especially for controlled goods. So those are your excise type goods, and there is a list available on gov.uk. Unfortunately, I can't remember it all off the top of my head, but it is by far and away the minority of goods classes as controlled, and they do need to require a declaration from the beginning of the year. And I'll talk a bit more about how we've been staging in customs controls on the next slide. But another thing worth noting is the easement for safety and security declarations on imports, worth saying not on exports. So this is the E&S declaration. There is a waiver until the beginning of January next year. So again, something just in the wider context to keep in your mind of things to be preparing for the end of next year. Or the end of this year, sorry, beginning of next. So during this year, we've also not required roll-on, roll-off locations that don't already have means to control goods to do so by declarations until the 1st of January next year. And I'll touch on, as I say, on the next slide, the different options for declaring declarations this year on the next slide. But it's worth saying that, importing goods from the EU, you can still make full declarations should you choose, and use any easements or any facilitations and authorizations you have applied for. You can use those if you would rather. And again, for full context, this only is stuff for the EU inbound into GB. The rest of the world continues as is. So if we just move on to the next slide. So this is, as I was saying, kind of the staged customs controls period that we're in at the moment for 2021, after the end of the transition period last year. These controls were originally due to end at the end of this month, but again, due to COVID and the wider implications that's had on the world we live in these days, we have now extended that through to January 2022. So this is where goods need to be pre-lodged in advance of moving through roll-on, roll-off locations, or again, the Common Transit Convention is still in play. We're now a separate contracting party to that. We weren't able to move to that in stages because it is an international agreement. But to facilitate the need for this and those pre-lodged declaration, what you can do if you're moving non-controlled goods into GB is declare them into your own records. This is generally known as an EIDR, so an entrance in declarants records, and it's details of the goods that you're probably already keeping for commercial purposes, dates, amounts, cost, routes, things like that. But there is again a full list of what's required on gov.uk for that entry. You'll then be required to make a supplementary declaration after 6 months, or within 6 months, or 175 days if we get down to the real detail. And for this, you will either need to be authorised to do so via CFSP, Customs Freight Simplified Procedure, or have an agent that is authorised to do so on your behalf. It's worth saying you don't need to have that authorisation to start with. You can make that EIDR without being authorised, but when it comes to making the supplementary declaration, that's when you need to have that authorisation in place. And as I said on the previous one, this isn't for controlled goods. For those controlled goods, we do still need a declaration, a frontier declaration to be made. But again, this can be simplified if you have the authorizations to do so. So that is a real whistle-stop run-through of the staging in of customs controls. But I know the focus of this session is on VAT, but hopefully that's kind of given a bit of context of where we are going through this year into next year. Back over to you, Mohan.
Brilliant, thank you very much. I'll now hand over to my colleagues Heather Elliott and David Pruden to go over some of the issues relating to postponed VAT accounting. Thank you.
It's just me. I'm hoping you can hear me. I've not joined in the way that I intended to today, so let me know if there are problems with hearing me.
I think we've got you, David. Yeah,
Can you hear
we
me
can hear
okay?
David. Yeah, we can hear you.
You
That's
can
really
hear me
good.
fine. Good. So the basics to start with: imports and acquisitions. So the good movements from goods from the EU to GB are imports. So they're no longer acquisitions, which means import VAT, not acquisition VAT, will be due if you're VAT registered. But acquisition VAT continues to be due on goods moved from the EU to Northern Ireland. Postponed VAT accounting, PVA, is available to UK VAT registered traders if you import goods into GB from anywhere outside the UK, or if you import goods into Northern Ireland from outside the UK and the EU. And postponed VAT accounting allows importers to account for and recover import VAT on the same VAT return, and it's available permanently. There has been some conjecture that PVA was just a temporary thing. No, postponed VAT accounting is permanently available. But other existing means of paying import VAT through duty deferment or upfront at the point of import, they are also available. And for non-VAT registered traders who pay import VAT, that is how they will do so when they make their customs declaration. Different rules apply to goods valued at £135 or less, but that excludes excise goods. So for excise goods, the rules for postponed VAT accounting apply to goods of any value. Next slide, please. So postponed VAT accounting available now. Don't need to be authorised or don't need to be enrolled to use it. And when you use PVA, means, as I said, you do not have to pay any VAT due at the point of import. Instead, you account for and recover import VAT on the same VAT return, subject to the normal rules on import tax deduction. Next slide, please. So to use postponed VAT accounting, now there are different rules here for excise in some respects. So I will cover those as I go through. So I'll cover the specific excise parts of this in appropriate places in this section. But postponed VAT accounting essentially selected on the customs declaration. And if you're using chief, which most people will be doing, you enter the trader's, the importer's EORI in the appropriate box on the customs declaration, or you enter the VAT registration number in the appropriate box if you're using CDS. And when you do so, an online monthly statement is generated, which the trader, the importer, is able to access and download. And that contains the information the trader needs to complete their VAT return. A bit more about that on a later slide. As I said, traders don't need to be authorised to use PVA, but they do need to subscribe to CDS to access their statement. And to use postponed VAT accounting, the imported goods do have to be used in the trader's business. A little bit more about that on a later slide. And non-established taxable persons, they're entitled to use PVA, but the normal rules apply here. In order to import goods into the UK, a non-established taxable person needs to hold a UK EORI and instruct an agent to make the customs declaration on their behalf. That's the normal position. It applies whether you use PVA or not. So we've gone to the next slide and some other circumstances where you can use it. So if you import goods and declare them into a customs special procedure, so typically customs warehousing, then when you declare the goods into free circulation from the special procedure, you're able to select postponed VAT accounting at that time. So the overview excise position is the postponed VAT accounting can be used when imported excise goods are released for home consumption. And this does include when goods are released from an excise warehouse having been in duty suspense since the point of import. And there's more slides on that to come. Now, use of postponed VAT accounting is normally optional, but as David has already said, if you import non-controlled goods into GB from the EU between the 1st of January and 31st of December this year, then you can use the staged customs controls procedure. And if you do so, you must use postponed VAT accounting and account for VAT on your VAT return. So the circumstances where you must use that are either if you delay your customs declaration, or if you use your simplified customs declaration where authorised to do so and make the declaration in your own records that David described. Put another way round, if you use the EIDR procedure, you must use postponed VAT accounting, whether or not you do in fact delay your supplementary declaration. Next slide, please. So yes, as would generally be the case, most people, in fact, will probably use another person to import goods on their behalf. And that can be a freight forwarder, customs agent, broker, fast parcel operator. There are others. But you do, as the importer, need to tell them how you want VAT to be accounted for on those imports so that they can complete the customs declaration in accordance with your wishes. And it may be that you already imported goods from the beginning of the year, but you need to contact that person and tell them that you want to use postponed VAT accounting. Otherwise, they will just continue to account for VAT as they always have, unless you've given them new instructions to use PVA. But with all this, keep a written record of what's agreed. That makes sure things are clear and evidenced for the future. Normal good practice. Next slide, please. So a bit more about business on business. I said earlier that you can only use PVA if you use the goods for the business. But to maximise when you can use PVA, we've said you're able to use PVA if you import goods which are used for both business purposes and non-business purposes, or indeed if at the time you import them you don't know whether they're going to be used for business purposes or not. You can use PVA in all those circumstances. And then if you're not using them for the purposes of the business, that is a matter that you can take account of when you decide how much input tax you're eligible to deduct on your VAT return in accordance with the normal rules. The only time you can't use PVA is if you know at the point you import the goods they are going to be solely used for non-business purposes, and in those cases you do have to select one of the other existing means of payment on your customs declaration. Next slide, please. So completing the VAT return. So these are the changes as a result of PVA. So in box 1 of your VAT return, you include the import VAT through postponed VAT accounting. You can then reclaim that in box 4 of the VAT return, subject to the normal rules. And box 7 is in where you include your net value of imports. Actually, box 7, it's no change really. That's where you would have put your value of imports anyway, even if you're not using postponed VAT accounting. So the normal rules, as I said, about what that can be reclaimed as input tax apply. You get the information from the monthly statement. But if you do, going back, if you are delaying your statement, I mean, if you're mandated to use postponed VAT accounting, then you have to account for the VAT on the VAT return, which covers the date that the goods were imported. But if you're delaying your supplementary declaration, you're not going to have your statement yet. So to complete the boxes in those cases, you need to estimate the import VAT due from your record of imported goods. So from your commercial records, from your EIDR itself. That will have the sufficient information to make the estimate. And when you do submit the delayed declaration, you have to select that you're using postponed VAT accounting, and then your online statement will arrive, or sorry, you'll be able to access it, and you'll then be able to find the appropriate entry on that statement, and compare it with the estimate you've made and account for any difference on your next VAT return. I mean, one thing to say is that if you're a fully taxable trader, then you'll be able to fully deduct the import VAT charged as input tax on the same return anyway. So any of these adjustments that we're talking about here, or I'm talking about, will also be nil net tax. So there's not going to be any tax implications here if you're fully taxable. If the goods are non-business, as I've said, or if you're partially exempt, yes, that is when there can be a tax effect. So we're on to the next slide. So accessing the PVA statement, I've said back to CDS to view it. I mean, that's a bit of a look to the future. We know that everybody at some point, in the next couple of years, it's going to be using CDS. So the PVA statement, we future-proofed it so that everybody actually accesses the statement on CDS. So if you're currently using Chief, you do, for the purposes solely of CDS, solely for the purposes of accessing your statement, you do actually have to go through CDS sign up in order to get your statement. Some, as a second bullet, will have CDS already. If and there they will find their statement when they go to look for it. But as I said, if you don't have access to CDS, you are automatically directed to subscribe to CDS first. And the signing up process should be straightforward and take only a few minutes. The monthly statements we've got for January to March, it's actually April and May will now be available as well. They come through usually around the 5th or 6th working day of each month. And just say, I've said it's straightforward. There have been some teething problems with this, but in most cases, these are now sorted. There is some guidance on the PVA pages, which explains what happened if you did have problems accessing statements, and in some cases getting duplicate statements for the first few months of the year. So if that's happened to you, there is some guidance on what to do. VAT groups, yeah, there's a change for VAT groups because of the way that CDS works. Each member of a VAT group that imports goods does have their own EORI, so they do need to sign up CDS individually to access their statements, and then they'll have to let the representative group member have those statements, because it's the representative group member who has responsibility for collating the statements and completing the VAT return. So that's the way that CDS works. It's different from Chief. Chief, when you get your hard copy C79 import VAT certificate, that there was just a single certificate went to the representative group member. So in some ways much easier, but that's the way the system works. So that's what that bullet point covers. So next slide, please. So this is a bit of material specifically on excise warehouses for ATWD, alcohol and tobacco warehousing declarations, which I think will be relevant to people on this call. So the basic position: postponed VAT accounting available for all imported excise goods released from duty suspense on or after the 1st of January this year. Now, I've said all that about PVA statements, but they are not generated where imported goods are removed from an excise warehouse. So in those cases, you need to retain the information that you use to make your ATWD declaration, or that the person who makes that declaration on your behalf, you need to have and retain that information, because that is what will support your completion of the VAT return to account for the VAT correctly, and it's also your evidence of input tax deduction. If you don't want to use PVA, I mean, I think everybody will be using PVA where it's available for imported goods in these circumstances, but as I said, the existing means of paying import VAT are still available, and if you use them, the owner of the goods will still get the import VAT certificate, the C79, and again that should be retained as evidence for input tax deduction. Next slide, please. So these are for completeness. I think it's just easier to go through the other circumstances where goods can be removed from excise warehouse, covering either supply VAT or acquisition VAT. But there is no change if the goods are home produced, or if they relate to EU to Northern Ireland acquisitions. There is actually no change from the way the rules worked. But the way these rules do work is that VAT is accountable by the owner or acquirer of the goods from the EU. That's unless they are subject to a supply before they're removed from warehouse. So where that does happen, where the goods are acquired from the EU and sold in warehouse, the acquisition VAT is extinguished and it becomes supply VAT, UK supply VAT, still VAT, it's just supply VAT, not acquisition VAT. And it's the final owner of the goods when the goods leave the warehouse that then accounts for the supply VAT. No change. And if it's just supply VAT, in any case, on UK home produced goods, the supply VAT is accountable by the final owner of the goods in warehouse. Now, supply VAT is because of the quirk of the way that the system works in a way. For supply VAT, the owner receiving the final supply in warehouse still gets a C79 certificate. They're not imported goods, but the way that the system works, you do get a C79, and you should use that to as evidence to reclaim the VAT as input tax. Next slide, please. So transitional arrangement. So in a way, this is just saying the same message put in another way, but goods arriving in GB from the EU before 1st of January in duty suspense, they remain subject to acquisition VAT when they are removed from warehouse on or after the 1st of January. Again, unless they're subject to a supply before removal from warehouse, in which case it will be supply VAT they're accounted for. And the fund, well, goods. So, but if goods are imported into GB or Northern Ireland from outside the EU before the 1st of January 2021 in duty suspense, they're able to use PVA when they're removed from excise warehouse on or after 1st of January 2021. So that means if you imported goods, say on the 1st of December last year, if they left the warehouse on the 30th of December, PVA hadn't been introduced yet, you can't use it. But if they left the warehouse on the 10th of January or at any date after the beginning of the year, then PVA has now been introduced and you can use postponed VAT accounting. So I hope that's clear, but happy to take any questions later, and I'll pass on to Will or back to Mojgan.
Brilliant, thank you. Yes, so just hand this to Will to cover concerns valued at 1. Thank you.
And hello everyone, can you hear me?
Yes.
Yep, thank you. So yeah, as Mojgan said, my name is Will Pereira and I work on the VAT policy for low value overseas goods at HMRC. And today I'll be talking through the next couple of slides on overseas consignments valued at £135 or less. So to start, the UK has introduced a new VAT model in terms of the treatment of overseas goods, and that's to improve both the efficiency and compliance of businesses accounting for VAT. The new model itself applies to goods imported into Great Britain from overseas and goods imported into Northern Ireland from outside the EU. So one of the main changes here is that VAT collection on consignments of goods valued at £135 or less has been moved away from the border, and businesses liable for the VAT now have to register and account for it on their VAT return. So from the end of the transition period, for goods located outside the UK at the point of sale and sold to customers in the UK in Great Britain, those customers will have UK VAT charged at the point of sale. And for goods located outside the UK and the EU at the point of sale and sold to customers in Northern Ireland, those customers will have import VAT charged. And it's important to remember that it's the location of the goods at the point of sale that matters rather than the location of the seller. We've also made online marketplaces responsible for collecting VAT in certain circumstances. So where an online marketplace is involved in facilitating the sale, it will be responsible for charging, collecting and accounting for the VAT instead of the seller. For goods sold by direct sellers, so without any marketplace involvement, the seller will be required to register and account for the VAT. And on the 135 limit, the limit applies to the total value of the entire consignment in which the goods are sent. So it doesn't apply to the separate value of individual items within a consignment. And on the last point here, low value consignment relief, also known as LVCR, which was an import VAT relief for consignments valued at £15 or less, this has been removed. So what this means is that VAT is now due on all goods supplied from overseas. And yeah, on the next slide, so for business to consumer supplies or B2C, this is where the customer is not registered for VAT in the UK, or it also applies to where a VAT registered customer does not provide its VAT registration number to the seller or online marketplace. So here, the seller or the online marketplace where it facilitates the supply will be liable to register and account for UK VAT on their VAT return. If they're already registered for VAT in the UK, then they won't need to register again. And for business-to-business supplies or B2B, this is where a UK VAT registered customer provides its VAT registration number to the seller or the online marketplace. So here, the VAT registered business customer is responsible for accounting for any VAT due on their VAT return. And for goods imported into Great Britain, this is done by a reverse charge procedure. And for goods imported into Northern Ireland, this can be done using postponed VAT accounting. And in both cases for B2B, businesses will be able to recover the VAT as input tax subject to the normal recovery rules. The last point here covers exceptions to the normal rules. So the rules that I've covered today do not apply to consignments containing excise goods or to non-commercial transactions between private individuals, for example, gifts. So these goods will be subject to the rules for consignments of goods valued above £135 with import VAT typically collected at the border. Okay, that's it for this section. I think I'll now hand over to my colleague Phil for the next part. Thank you.
Brilliant, thank you very much. So we're now just moving over to the element of this presentation relating to Northern Ireland Protocol. Thank you for your patience. Hopefully we've got a couple of trader journeys here, so hopefully this element of the presentation will be a little bit more interactive and you haven't fallen asleep already. Thank you. So without further delay, I'll hand over to Phil Crawley to cover this section. Thanks.
Thanks, Mujgan. Yeah, so my name's Phil Crawley and I work within the Northern Ireland VAT Policy and Delivery team at HMRC. So I'll be explaining how VAT operates under the Northern Ireland Protocol in this bit of the presentation. So we kick off with movements between Great Britain and Northern Ireland. So for most transactions where goods are sold between Great Britain and Northern Ireland, VAT registered sellers should continue to charge their customers VAT and account for it on their VAT return. However, this is now import VAT and is subject to import VAT rules, which include rules on valuation. This means that VAT is calculated on the customs value of the good, which includes incidental expenses such as transport and insurance costs, as well as any customs or excise duties that are due on the import. Import VAT does not need to be paid at the point of arrival into Great Britain or Northern Ireland, as it will be accounted for via the VAT return instead in most cases. The customer, if VAT registered, can reclaim input VAT subject to the normal rules. However, there is a new requirement where a business moves its own goods from Great Britain to Northern Ireland. In these cases, import VAT is now due. The business may reclaim that VAT as input tax subject to the normal rules. Therefore, there should be no tax effect for taxable businesses, as they should be able to claim input VAT in box 4 on the same VAT return in which they account for the output tax in box 1. An import VAT charge does not arise where a business moves its own goods from Northern Ireland to Great Britain, unless this is done as part of a sale or supply of the goods. However, the principle of seller liability does not apply in the following cases. So where goods are subject to domestic reverse charge rules, in this case, the customer should continue to account for the VAT via the VAT return and can reclaim import VAT subject to normal rules. Additionally, goods declared into a special customs procedure, such as customs warehousing, where this is used, the customer or importer must account for the VAT when the goods exit the procedure. On top of this, you've got goods which are subject to an onward supply procedure, which is available where the goods move from Great Britain to Northern Ireland and are consigned to be moved onto a final destination in an EU member state within 1 month. In this case, the final customer in the EU is required to account for the VAT as acquisition VAT. The importer, in this case, should zero rate the goods, but would need to include this onward supply on their EC sales list. And finally, as has been touched on previously, goods sold by a non-UK seller through an online marketplace. In this case, the online marketplace is liable to account for the VAT. So moving on to VAT groups now. VAT groups can continue to include members established in Northern Ireland as well as members established in Great Britain. So there is no requirement to restructure a VAT group which has members in both Great Britain and Northern Ireland. Additionally, broadly speaking, transactions between UK VAT group members continue as before and in most cases can be disregarded for VAT purposes, with a small number of exceptions. So these are where we have a supply between group members in which the goods move from Great Britain to Northern Ireland. In these cases, the goods should be accounted for in the same way as a movement of own goods, which, as touched on previously, consists of an output VAT and an input VAT entry on the VAT return. Also, supplies of goods in Northern Ireland between members where at least one of the members is not established in Northern Ireland. We have an exception in this case, which means that VAT cannot be disregarded and will apply. So the group's representative member will need to account for this VAT and can reclaim the VAT subject to normal rules. So now looking at goods moved by non-VAT registered businesses or individuals. So goods moved or sent from Great Britain to Northern Ireland by unregistered businesses or individuals will incur import VAT, though in most cases the liability will be reduced to zero. This is because a credit is applied, which is valued at the amount of VAT that has previously been paid on the goods in Great Britain. As it is rare for the value to have increased between buying an item in Great Britain and sending it to Northern Ireland, the credit will cover any import VAT liability that would be due in most cases. However, in cases where goods have not already had VAT charged on purchase, or where the value of the goods has significantly increased since purchase, the credit will not cover the full liability and import VAT will be due. Individuals and non-VAT registered businesses carrying goods will need to use the relevant app to pay the import VAT, and individuals and non-VAT registered businesses selling goods will need to use a different solution, which HMRC will introduce later this year. HMRC will expect individuals and unregistered businesses to keep records that will enable them to account for the import VAT when this is rolled out. Goods moved or sent from Northern Ireland to Great Britain by individuals and non-VAT registered businesses do not incur import VAT unless they have been subject to a VAT Red claim. The VAT Red scheme is still available in Northern Ireland, allowing visitors from outside the EU to recover the VAT on purchases they make and then take home in their luggage. It's technically available for NI retailers to visitors from Great Britain, although the retailer must collect the import VAT that would have been due upon the customer's return to Great Britain on the customer's behalf and account for it on their VAT return. The retailer can then only refund the supply VAT to the customer once the VAT 407 form has been returned to them, having been stamped by a customs officer when the customer leaves Northern Ireland, or if they leave the EU, for example, if they return home via Dublin. However, the VAT refund given in this way and the import VAT that should have been charged by the seller should be the same amount and net off to zero. For this reason, retailers may decide not to offer VAT Res to visitors from Great Britain. So now moving on to goods moving between Northern Ireland and EU member states. In line with the Northern Ireland Protocol, suppliers of goods from Northern Ireland to the EU and vice versa continue to follow intra-EU rules for VAT. So in terms of the VAT process, this remains pretty much as it was prior to the end of the transition period. When we talk about suppliers from Northern Ireland to the EU and vice versa, we focus on where the goods started and where it ended, rather than the place of establishment of the business. For example, a business established in London sending a good from its warehouse in Belfast to a customer in Dublin will be making a supply from Northern Ireland to an EU member state, so this would be an intra-EU supply. The supply of services is not covered by the Northern Ireland Protocol. However, the rules for the place of supply of services are broadly unchanged. Some exceptions are covered in the slide, and further guidance is available on these on gov.uk. For business to consumer sales, distance selling rules continue to apply. So for sales from an EU member state to Northern Ireland, if an EU business makes more than £70,000 worth of sales to Northern Ireland consumers annually, they will have exceeded the Northern Ireland distance selling threshold. This means that they must register and account for UK VAT on their Northern Ireland distance sales. For sales from Northern Ireland to EU member states, each EU member state has its own annual distance selling threshold, which Northern Ireland businesses have to take account of when selling to EU customers. So, for example, if France has a particular distance selling threshold, once a Northern Ireland business exceeds that amount, they would need to register for French VAT. For business-to-business sales, where the customer is VAT registered, the customer should account for acquisition VAT. The recipient must account for any output tax on their VAT return and may also treat this as input tax on the same VAT return, subject to normal rules. Where a Northern Ireland seller sends goods to a VAT registered customer in the EU, the Northern Ireland seller should zero rate the goods. The seller must continue to submit an EC sales list accounting for the supply of such goods. However, as stated previously, as suppliers of services are not covered by the Northern Ireland Protocol, these would not need to be reported. There is a new requirement for businesses carrying out transactions with the EU to use the XI prefix when communicating with EU systems or businesses, for example, on invoices. This requirement applies to businesses who do one of the following: businesses who receive goods in Northern Ireland from VAT registered EU businesses for business purposes, who sell or remove goods from Northern Ireland to an EU member state, or that sell goods that are located in Northern Ireland at the time of supply. HMRC identified certain businesses that require the XI prefix and contacted those businesses before the end of the transition period. However, businesses can still notify HMRC to request the ability to use the prefix through submitting a G-form on gov.uk. Businesses that have an XI prefix will continue to appear on VIEs on the web, so that EU businesses can continue to check their VAT status and verify that they are trading under the Northern Ireland Protocol. This will enable EU sellers to correctly account for their sale to businesses trading under the protocol. So the EU VAT refund system is available to VAT registered businesses who have an establishment in Northern Ireland and who make supplies of goods in or from Northern Ireland, or who make intra-community acquisitions from the EU. These businesses can use the electronic EU VAT refund system for VAT incurred in an EU member state for invoices that cover goods only. If a business doesn't meet these conditions, or if the VAT invoice that they have covers a transaction in services, they must use the EU 13th directive process. Under this process, a claim must be made to the authorities in the EU country where the VAT was incurred, and you can find further information about this process on the EU Commission's website. So now moving on to situations where goods are sold from Great Britain to the EU via Northern Ireland. The VAT treatment will depend on where the goods are when the transfer of rights to the goods takes place. If the goods are located in Great Britain at the time of supply, the seller should charge the customer VAT and account for it on their VAT return. Only the EU customer can recover the VAT, either using the EU VAT refund system or a UK VAT return if they're registered for VAT in the UK. If an onward supply procedure is used, import VAT will be due in the EU member state of destination and accounted for there as acquisition VAT. Additionally, if a customs special procedure is used, such as transit, import VAT is due where the goods exit the procedure. The importer must tell the seller when they have used one of these procedures and provide the required references so that the seller can zero rate the export. So here's a visual example of that journey. This scenario, we have Samir's London-based business selling goods to a customer in Dublin. The goods will be transported from London to Dublin via Belfast. So the goods start off in Samir's GB premises and are sold to the customer in the Republic of Ireland while they're there. Samir should charge UK VAT to the customer. This will be import VAT, which should be accounted for via his UK VAT return in the same way as output VAT. So then the goods make the cross into Northern Ireland. No additional import VAT is payable as part of any customs process. And after this, the good can move freely from Northern Ireland into the Republic of Ireland. The goods arrive at the customer's address in Dublin. The customer can recover the VAT paid using either the EU VAT refund system, or if they're UK VAT registered, they can use their UK VAT return. Now, if the goods are moved to Northern Ireland before they are supplied, then two separate movements need to be accounted for. The first is a movement of own goods from Great Britain to Northern Ireland by the seller. As explained previously, this is basically an in-out entry on the seller's VAT return of output VAT and input VAT. And then this is then followed by an intra-EU sale. So here's a visual example of this journey. Charlie's London-based business moves goods to Northern Ireland in preparation for selling to customers. And then he then makes a sale of the good from Belfast to a customer in Dublin. So the goods therefore begin in Charlie's depot in Great Britain and are moved to be stored in a different depot in Belfast. The goods make the crossing from Great Britain to Northern Ireland, and Charlie must account for this as a movement of own goods to Northern Ireland, accounting for import VAT as if it were output VAT, and can reclaim input tax subject to normal rules. The goods are moved to Charlie's Belfast depot, and once they are there, they're supplied to a customer in Dublin. This is then accounted for as an intra-EU sale. The goods are then freely transported to the Republic of Ireland and arrive at the customer's address in Dublin. The VAT is reclaimed via the customer's VAT return if they're VAT registered. So now I'll talk through the reverse journey, where goods are sold from an EU member state to Great Britain and go via Northern Ireland on their journey. The EU business should charge the customer UK VAT and will have to register if they're not registered already, and account for the VAT on a UK VAT return. The UK customer will be able to reclaim the VAT as input tax subject to the normal rules. So here's an example of that. Abdul's Dublin-based business sells goods to a customer in Dublin. The goods are transported from Dublin to London via Northern Ireland. So the goods begin at Abdul's premises in the Republic of Ireland, and they are then sold to a GB customer while they're there. As the goods are going via Northern Ireland to a customer in Great Britain, he will need to be VAT registered in the UK and should collect UK import VAT at the point of sale, accounting for it via the UK VAT return. The goods are freely transported to Northern Ireland and make the crossing to Great Britain. When they arrive in Great Britain, no additional import VAT is payable as part of any customs process. The goods are then driven to the customer's address in Great Britain, and the customer is able to recover this as input tax via their UK VAT return, subject to normal rules.
Brilliant, thank you very much. That's 45 minutes of your time you've taken there. But that brings us to the close of our presentation on VAT from the HMRC perspective. We're happy to take any questions, and I'll hand over back to the chair to manage the Q&A session. So over to the chair, thank you.
Thank you, Moshgan, and your team, most appreciative. Andy, we've got you next on the agenda. So rather than the Q&A, do you want to step in, Andy? And the floor is yours.
Thank you. I'll just share my screen. Morning, everybody. So what I'm going to do is talk about some of these aspects from a practical perspective. So just checking you can see my screen. Okay.
Yes.
Yeah,
fine.
perfect. Okay.
Yeah.
So I'm going to talk for about 20 minutes, so not quite as long. So really, I'm going to highlight the need to analyze the supply chain. So as HMRC pointed out, VAT is a tax on transactions. So the key thing is to understand the transaction that's taking place. If you don't understand the transaction, you're not going to be able to understand the VAT implications. There's often a lot of relevant information that you need in order to be able to determine the VAT treatment. So who are the parties? So that determines whether it's a B2B or a B2C transaction. And that's important because sometimes the place of supply rules will differ depending upon whether it's B2B or B2C. Key thing is you need to understand what is the transaction. So what's actually being done. So is it a supply of goods or is it a supply of services? And again, that's key because the rules for determining the place of supply will be different depending upon whether it's goods or services. And often determining what the transaction is can often be tricky because the boundary between what's goods and services can often be indistinct. So that can often take some time to work out whether it's goods or services. The key question then is where's the place of supply? So the place of supply is the place where the VAT's due. So that's where there's a liability to account for that VAT that's due. And that's the primary focus of a lot of the work that we do, is helping businesses to understand where do they need to account for that VAT. So there's detailed rules within the EU which set out the place of supply. So they're to provide consistency of treatment and to remove the prospect of double taxation where something's taxed in two places, and remove non-taxation where a supply should be liable to tax. So obviously the UK is no longer covered by the VAT rules in the EU, but in most cases we've kept rules in a similar way. So there's not been significant changes to the way that we apply VAT. The obvious distinction, as pointed out by HMRC, is where goods move between Great Britain and the EU, they're no longer dispatches and acquisitions, they're exports and imports. But the place of supply rules, you need to look at where the place of supply is, determine that based on who the parties are, based on what the transaction is, so you can then determine where the VAT is due. Once you've done that, you then need to work out what rate of VAT applies. So is it the standard rate? Is there a reduced rate available, or is there an exemption? So an exemption means you don't have to charge any VAT. There can be exemptions with credit, where you can recover the VAT that you incur on the costs, and exemptions without credit, where the cost, the VAT on the cost that you incur are going to be a cost to the business. And then the final stage is who's got the liability to account for the VAT that's due on that supply. And this is the critical decision, which is determining whether a business has to register for VAT or not, based on the transactions that they're undertaking. So the default position is that the supplier charges, but that can switch to the customer in certain circumstances if there's a reverse charge applicable to the goods. So that's a very brief overview of what you need to do. If we then look at it in terms of exporting and importing, so Incoterms are the key factor now. So they determine the responsibilities for exports and imports. And what we've seen as a business, particularly since the both before and after Brexit, but particularly since the 1st of January, is increased pressure for suppliers to supply on a delivered duty paid basis, so DDP. And we've seen that that's often where customers are just not used to importing. So the single market was in place since '93. So lots of businesses, if they're trading with UK companies or GB companies, just aren't used to the complexities of importing. So they don't want to have that burden, and they can also be concerned about the VAT and the duty. So that's a real challenge. Pre-Brexit, Incoterms obviously applied, but they were less important for UK EU trade. They were critical in chain transactions, but in many cases, if it's just a two-party transaction, it didn't really matter whether it was DAP or DDP, because there were no duties and there was no VAT payable, because the goods didn't cross the border. But as I've said, they're now fundamental. So I'm going to look a little bit about some of the implications of selling on a DDP basis. So we talked about the place of supply. The place of supply is critical. So when goods are being moved from one member state to Great Britain, the Incoterms that apply to the contract will determine the place of supply, and that's where complications will arise if those Incoterms are DDP. If they're not DDP, there's an import by the Great British customer, so the customer will be liable for the UK VAT on that import. As the representative from HMRC said, postponed VAT accounting is now available, so there's no cash flow impact. So there's no downside to a business importing goods from a cash flow perspective. As long as they're fully taxable, they can recover all of that VAT. They just put it in boxes 1 and 4, so there's no need to physically outlay any cash. Again, as was highlighted by HMRC, making sure that there's an instruction to whoever's processing the declaration that postponed VAT accounting is being claimed, because we've seen a number of instances where the business isn't aware that they've got to do that, so they're then having to pay the VAT on import. They can still get it back, but obviously there's a cash flow impact if they pay it up front. So again, duties, they're going to be in line with the Trade and Cooperation Agreement. So if it's EU origin, there's no duty. If it's not EU origin, the business needs to consider whether there's another free trade agreement or GSP available. Otherwise, duties will be in line with the UK global tariff. So in many cases, the implications of importing goods by a GB business will not necessarily be that significant, certainly from a VAT point of view. And if the goods are of EU origin, there won't be any duties on them either. So if DDP has been agreed, And what we've seen is that often contracts would have been agreed some time ago, so consideration wasn't given to whether what Incoterms should apply to the sale. So if DDP has been agreed by a salesperson without considering the implications, our advice always is to see whether it's possible to change the contract with the customer, because that will remove the burdens of having to import the goods. If that's not possible, it's likely that VAT registration is going to be required. If there's no need for registration, the issue is then going to be about how to recover that import VAT. So it's always preferable from our perspective to try to minimize the burdens for an exporter in selling goods to their customers. So if we look at that scenario from a Dutch business selling goods B2B on a DDP basis, so the Dutch business will be liable for the VAT and the duties as importer. They'll need a UK EORI in order to be able to import the goods into Great Britain. They'll also need to appoint an indirect customs representative as established in the UK. And then it's likely, if they're just selling those goods, there's likely that there's going to be a local supply of those goods in the UK, because the place of supply of goods that are imported by the seller is the country of import. So I mentioned about the reverse charge. A lot of EU member states have got an extensive reverse charge. The UK has for services, but not for goods. For goods, it's really applicable to items that have been subject to fraud, so things like mobile phones. So if the goods that you're selling aren't covered by a reverse charge, there will be a liability for that Dutch business in this particular example to be registered for VAT in the UK. So that's something that they'll need to factor into the cost of fulfilling the contract, and we often get involved in discussions with businesses at tender stage. They want to understand the implications of the contracts that they're carrying out, so they can factor in the obligations in the UK. Fortunately, the UK VAT system is relatively straightforward. It's normally quarterly returns. There might be payments on account if you're a large business, but it's normally quarterly returns. There's no real-time reporting at the moment. There's no SAFT declaration, so it's relatively straightforward compared to the regimes in some of the member states around the EU. But businesses will need to factor into their costs the compliance obligations which they're going to meet in the UK. If they don't have to register, that's beneficial, because obviously they've removed the compliance cost on an ongoing basis, but they need to think about how they're going to be able to recover that VAT. So the principle of VAT is it shouldn't be a cost to business if they're a fully taxable business, but it's that mechanism that you're going to need to be able to recover it. If you're registered, you can obviously recover it on the VAT return. If you're not registered, you're going to need to make a claim to HMRC, and there'll be a delay in receiving that money, so there'll be a cash flow impact. And obviously if you're not registered, you can't use PVA. If we now look at that same business selling on a B2C basis, so direct to the customer, so there's a number of factors which need to be taken into account. And I think the reality now is that, especially on a B2C contract, the difficulty is when you're selling goods to a customer, you need to take into account all of these factors when you're at point of sale, because it can impact how the VAT's going to be accounted for. So we've heard about how the value of goods is important. So below £135, the e-commerce scheme is compulsory. So there's no choice if you meet the conditions to apply the scheme. The EU are introducing a similar scheme on the 1st of July, the EU e-commerce package, but their system is not compulsory. You can still choose to import the goods in the way you did previously. That's not applicable in the UK because of the change from goods below being 135 being from import VAT to supply VAT. You can't just choose to just pay import VAT because that's not an option that's available anymore. So another factor when you're selling B2C is the location of the customer. As we've heard, the Northern Ireland Protocol significantly complicates situations. So when I'm talking about UK GB, you've always got to think about talking about GB because you've got to take into account the Northern Ireland Protocol. So as we've seen, EU rules apply if you're selling goods from the EU to a customer in Northern Ireland. Those changes that are happening in the 1st of July with the EU e-commerce VAT package will apply for sales from the EU to Northern Ireland as well. So there's going to be a simplified mechanism for accounting for the VAT due, the one-stop shop. So rather than having to register everywhere, EU businesses can just count in one country. You also need to think about the sales channel. So platforms have got liability in certain cases. So if you're selling them via Amazon, Amazon will take on the liability in certain cases. And also, where are the goods when you're selling them? So as was pointed out earlier, where the goods are is a key determining factor. With goods, it's always about where the goods are, rather than where the supply is based. So there's a lot of complications, a lot of factors that need to be taken into account to determine the right VAT treatment when you're selling on a B2C basis. So if we look at it the other way round, so a GB business exporting to the EU, essentially the same issues are going to arise. So if you're going to sell on a DDP basis, you're going to need an EU EORI, you're going to need a customs representative. The position is more complex because, as I mentioned, there's EU countries use the reverse charge in a different way from the way that the UK has and continues to do. So many countries, if you sell goods as a non-established business to an established customer, there's a compulsory reverse charge mechanism. So that means you don't need to charge any VAT, you don't need to register, which on one side of things is good because that will reduce your costs, but you need to consider the impact of incurring that import VAT. So the 13th directive recovery mechanism was mentioned previously. So that's a paper-based system. It takes longer to get claims. It's not like the old portal that you could use whilst the UK was part of the EU. So you have to make a claim directly to the member state, and they will impose the principle of reciprocity. So if UK tax authorities won't allow a claim from a business in that country, that can prevent a claim being made by a UK business. So you need to think about where the VAT's going to be incurred. The other issue for GB businesses registering for VAT in the EU is fiscal representation. So in the UK, generally HMRC don't impose fiscal representation unless there's a need to protect the revenue. That's not the position in other member states. So a lot of member states have a requirement for fiscal representation. So that's a local entity which takes responsibility and often joint liability for the VAT with the taxpayer. So if you have to register, you need to think about whether you need to appoint a fiscal representative. Now, this is one of the many areas that are still currently in flux. So the EU-UK Trading Cooperation Agreement included provisions in relation to mutual assistance and recovery. So the question at the moment is, do those provisions within the TCA have equivalence to the provisions that were in the Mutual Assistance Recovery Directive that the UK used to be party to whilst we were still part of the EU? So some member states have said they think it does, and they've therefore removed the requirement for fiscal representatives for UK companies. Some countries have said, well, we think it does, and we're going to reserve our position and will allow businesses to register without a fiscal rep in anticipation that there will be equivalence. But the European Commission hasn't made a decision on equivalence yet. So there's still some doubt as to how that's actually going to apply in practice. So there is a need to consider the position with fiscal representation if you do need to register, recognising that it could possibly change over the coming months. And as I mentioned a couple of times, the EU e-commerce package being introduced on the 1st of July. So if you're a GB business selling to the B2C into the EU, you need to take account of this e-commerce package. They've introduced it for exactly the same reasons as the UK has. So it's to avoid distortion of competition. So the EU's removing low value consignment relief, which currently is up to €22, they're removing that, so VAT will be due on all sales. They're also making some changes to what they've seen as abuse, where goods are imported into the EU in the name of the customer in one member state. So, for example, into the Netherlands or Belgium, because they're easy access points to the EU. VAT is paid in that country, but then it's then shipped to another member state where the final customer lives. So in that situation, tax authorities in the member state of consumption aren't getting any VAT, and they've changed the rules so that will no longer apply. So if you are selling goods on a B2C basis, you need to be aware of the e-commerce package and the changes that are going to arise in 3 weeks' time. So finally, just what do you need to do? I mean, we talked to businesses a lot about Brexit before the end of the transition period. They needed to formulate a plan. There's still a need to do that now. Businesses change, they evolve, they enter into new supply chains, they enter into new countries. Nothing stands still. So they need to make sure, that you're reviewing the impact on your supply chain of Brexit and the ongoing complications that brings. So thinking about Incoterms, thinking about contracts, understanding the place of supply of the various transactions that you enter into. Did you use simplifications previously? So triangulation using a GB VAT number is no longer possible. So it might mean you need to be registered for VAT in the EU. And one of the things that we've always found is that whilst you're trading within the EU, it's very easy to not be VAT compliant. Because goods can move freely without any customs borders, it's very easy to undertake transactions without being compliant. You need to understand what those transactions are, what the place of supply is, what the obligations are, because that will help you to ensure that you're compliant, and there's not going to be a nasty surprise at some point in the future when the tax authorities say that you've been dealing with something wrong for a number of years. You need to be able to import goods. We've seen lots of issues with businesses being able to import goods. So depending upon which way the goods are flowing, you need the GB or the EU EORI. You need a customs representative. You need to make sure all these things are in place, or goods are going to get stuck at the border. You need to understand the trade and cooperation agreement. Origin becomes a really important issue, which many businesses haven't had to consider before. Classification of the goods is key. The Northern Ireland Protocol, as was really well explained by HMRC, is a complex situation. You need to understand, because some of the conclusions and consequences just don't make sense from a perspective that, well, we're no longer part of the EU. We are, if you're talking about the Northern Ireland Protocol. You need to look at the requirement for VAT registration. Do you need to be registered, taking account of VAT recovery, reverse charge? Fiscal representation needs to come into that calculation. And finally, you need to think about, how do you recover your VAT? So VAT, as I've said, shouldn't be a cost. If it is a cost, that's going to significantly erode profit margins, and it needs to be recovered. PVA in Great Britain allows you to defer or effectively postpone the VAT return if you're registered. Many other countries within the EU have got similar systems. The way they work are not always as generous as the UK. Some systems allow it automatically for everyone. Other countries, you have to apply. Other countries, they've got deferred accounting but not postponed. So the position in every member state is different. And then finally, just making sure that you've got an action plan. You understand what you need to be thinking about and update it regularly as your business evolves. If you enter a new transaction with a new country, don't assume it's going to be the same as the same transaction in a different country, because it doesn't always work that way. Okay, so hopefully that has been of use. So it's a very quick run through, some conscious of time, but I'll pass back in case there's any questions.
Thanks, Andy. Appreciate that. I thought that was really insightful. So hopefully that stimulated some thoughts and hopefully a few questions on our Q&A. Graham, are you in a position? I think we're conscious of time. That gives us about 15 minutes for a Q&A session. you're in a position to facilitate that. I'm not sure what questions have come through to you, but it'd be good to start there. Yeah,
we've got a couple that have come through in the meeting chat, but if you've got any more, you can just raise your hand or just put it in the chat facility. But Carol Cundran from Edrington, you were just asking, is the date for full customs control guaranteed? I think that was to HMRC.
Graham, I can say a little bit more about that. It's obviously because it's been rolled out for another 6 months. So it's just looking ahead to get confirmation that as of January next year, we will have full customs control at all ports in the UK.
Okay, is that Mojgan? Is that something you're able to assist with?
Thank you. Yes, so I'll hand over to David or Carmel from the customs team who are on the call. Thank you.
Sorry, I suspect that's to do with the phase controls and for GB moving to the 1st of January. Yeah. At the minute, yes, that's the code. That's the date that we have that we're working to.
Okay.
Yeah. Unless David, you want to comment?
Sorry, I was slow coming off mute. No, I think you know, the dates we have are the ones that are pretty firm now and need to be worked towards. So yeah, I think you covered it, Carmel.
Okay, thank you. Thanks.
So just from me, yeah, David, it's Clive here. So are you absolutely certain it's not going to move, or you're not certain it's not?
We're not planning on any moves or working towards any potential changes. I mean, the political world is a different one. But as far as we're concerned, those dates are firm. And what we're hearing from the political side also is those dates are firm.
Okay, yeah, great, thank you.
All right, great. There was another one from Kathy Thompson at White Mackay, and Kathy was just asking if goods are being moved to Northern Ireland under excise duty suspension, does the customs value need to include excise duty?
Do you want me to come in on that, Mushkan?
Yes, please. Thank you.
The customs value, it's the value used as a basis for the customs debt, for the customs declaration. So any duties, customs, excise, or any VAT value adjustments are then calculated on and added to that figure to arrive at the VAT value. So if you're suspending any duties on the declarations, then they won't contribute to the customs debt for the declaration. So depending on how you're suspending those, whether it's via procedure codes or whatever, say you're putting it into an excise warehouse or whatever, but they won't contribute to the customs debt then if they're being suspended. So hopefully that answers it. Kathy, okay. Is it? Yeah.
Yeah, well, that's fine. So basically, if they're going from excise warehouse in the UK to excise warehouse in Northern Ireland, then the customs value doesn't have to include the excise duty because it'll be suspended at that time when it enters.
If you're using, if you're using a procedure code to say that it's moving from warehouse to excise warehouse, yeah.
That's great. Thanks. Yeah.
All right. Thank you very much. Kevin Shaw at RAPL. I think you're still on the call. You sent it was a rather long kind of question in, but I think you just wanted a couple of things confirming. Do you want to raise that now?
Yeah, I can do that. Hi, Graham. Thanks. It's mainly around excise stock in free circulation and acquisition VAT applicability. We have the same flag in our system to determine whether it's PVA or acquisition VAT. So determining whether it's one or the other. I said, is it dependent upon when the customs duty tax point was? So if it's in our warehouse, but it was the import entry date was pre-Brexit, it would still be acquisition VAT. If it was post-Brexit, it would be PVA. Is that correct?
David Pruden, did you want to come in on that?
Yeah, I mean, I think that's what I covered on the transitional slide.
Yeah, I think it's So it's the customs duty tax point. I mean, we have facility in our system to be able to pay a customs duty while it's in the warehouse. So that would be classed as a tax point, wouldn't it, as well? So if it had, you had free circulation stock, they had him, and the customs duty tax point again was pre-Brexit or post-Brexit. Pre-Brexit would be acquisition VAT rules, post-Brexit would be PVA, and that condition as well, wouldn't it?
Yeah, I mean, yeah. Well, there were, as what I tried to cover it on that slide anyway, the sort of two different circumstances were if it was in the EU anyway and it was subject to acquisition VAT, then yes, first of January is the key point, and it's still subject to acquisition VAT after that. So you're sticking with the EU rules, because if the goods are already in the excise warehouse, of course there won't be any. If they've gone into the excise warehouse before the 31st of December, there wouldn't have been any customs duty anyway, because they would have been acquisitions. And the position I'm trying to explain is different if these were, if these came in from a rest of the world country, when actually at that point, the 1st of January, PVA simply becomes available.
Okay, thank you very much. That answers my question. Thank you. Cheers.
Right. Thank you very much. Sorry, Clive, I kind of partially wrote down the question you asked me yesterday, but you did have a question about special procedures, STW.
Yeah, thank you. I think David actually covered it in his presentation, because we know, as David made clear, that because we've got this acquisition PVA, going on within our W5Ds that we declare through an excise warehouse, is that those PVA, what were PVA kind of claims, are not going to sit on any PVA statement because they're not separately defined. My question was, and I think David covered it, was that when you make an STW declaration out of a customs warehouse into free circulation, David, those declarations will show on the PVA statement. That's the question I raised yesterday with Graham. I think you've answered that by saying, right, customs special procedure, including a customs warehouse, you submit an STW through your software provider into Chief or CDS going forward. That will show on the PVA statement. Yeah. Yes.
So apart from where I mentioned stuff going into an excise warehouse, if all other situations, including where the goods leave the customs warehouse, yes, you can use PVA when you declare goods out of a customs warehouse or other special procedure into free circulation.
Yeah, great. Yeah, thank you, David. Yeah, that was it. That's the answer I was looking for. Thanks, Graham.
Okay, no problem at all. That's actually covered all the questions that we have, but does anyone else have any questions that they want to raise at this point?
I can't believe there isn't one. Cool. Really?
Well, if there is, and you haven't thought of it yet, I know there was a lot of information to digest, but you can send it to us after the meeting, and we can certainly forward it on to the relevant person.
Okay. Can I just jump in again, actually, Graham, around the import, and really a question for Andy, really, and his experience, with NBCC members and his customers and clients, is that, have you been seeing, has there been an issue around the ability for that import VAT to be deductible from your traders, clients, customers, members' perspective, Andy?
I think there's still complications, and it's not clear to everybody about how PVA works. I think that's just a natural consequence of a change in the system, the need to tell freight forwarders that you need to claim it. There's been some difficulty in downloading statements. People aren't quite sure what they need to do. Also, the fact that you need to do it within a certain timescale. So I think there's just teething problems. I mean, the reality is that I think the way a lot of businesses will look at it is that because there's a nil net tax situation, it's almost like the reverse charge on imported services. If you don't do it, there's no consequence. And in reality, that's right. I mean, it's obviously not the right thing to do, and we'd always advocate to clients that they should be making sure they account for all the VAT, even if it's fully recoverable. Sure. But the consequences of that are lesser than if they make other areas. But I think it's just taking time to bed in a new system. And I think some businesses are still surprised when they see a C79 because they paid the VAT on import. They thought that system had gone, but as was highlighted by HMRC before, that system's still there if for whatever reason you don't want to. Although our advice always would be, if you can postpone, why wouldn't you postpone?
Yeah. Yeah. Well, yeah, it makes no sense. It's a no-brainer, is it? Really?
No, exactly. Yeah. So why pay something if you don't have to? And
exactly.
the challenge we see is when UK businesses are selling to the EU is to try and make use of similar reliefs within the EU. That's much more challenging. Like in the Netherlands, you need an Article 23 license. In Belgium, you need a license. Some countries it's automatic. That's when you're going the other way, it becomes much more challenging.
Sure, indeed. Yeah, and another just a general question, I think, both to HMRC and Andy, with the with e-fulfillment is obviously taken on huge significance, and an awful lot of trade is occurring through those kind of platforms. The VAT implications around that. Just a question, general question: is everybody? We've touched on that today. Is everybody comfortable with the possible implications and consequences of trading through that kind of platform or marketplace?
I think the EU's gone the same way as the UK in terms of marketplace liability, and that's happening all over the world. The tax authorities are rightly seeing that it's much easier to collect from the platform rather than thousands of individual sellers. So the way that it works differs. The principle's the same, but I think that's a trend that's going to continue. But it's just, I think the difficulty which we're seeing is that depending upon the way that you sell your goods, depending on the value, you can have a different VAT treatment. So you could sell exactly the same goods to the same customer, but in two different ways, and you've got a different VAT treatment. And it's about how you deal with that complexity at the time of sale, because how you're going to account for the VAT will determine what documentation you raise, what's going to feed through to your VAT return, etc. It can be challenging, and I think certainly our experience of talking to the platforms is it's challenging for them as well, because they're having to make significant changes and they're having to work out when they're liable, when they don't necessarily have all the information which they need in order to make those decisions. These things have been planned for a long time, but they're still very challenging to implement. Like anything that's new, it's like Brexit. We knew it was going to happen for 4 years, but the number of businesses that we spoke to in sort of just before December and even in January and February, because there's still a lack of clarity on certain aspects, and I think people don't always fully appreciate the implications of these changes until they happen. No, I think that's a good check. And I see another kind of cliff edge coming 1st of January 2022, quite frankly, isn't it? We got 6 months, close to coming on to 6 months before the full kind of controls come into place, and I'm sure there'll be some consequences as a result of that. Businesses that are exporting to the EU have had to deal with all the implications because they haven't delayed anything. Whereas, as we've talked about, in the UK, things have put back initially 6 months, now 12 months. So that's going to be a real challenge, I think, for everybody, undoubtedly. Yeah, agreed. Yeah. Thanks, Graham.
Okay, no problem at all. I think that's everything we have. Yeah.
No other questions? Well, we seem to have grabbed back 3 minutes. That's pretty good. I thought at one point we were heading for 1 o'clock, but no, that's really good. So if we're now down to 2 minutes, so I think that's we're spot on. I think that's been really good. As head of or chair of the BWA, I think that's been really informative. So thank you, Morgan, and the rest of our HMRC colleagues. That was really good, really informative. So thank you for your time, and Andy as well. I think that's to see it from the more practical aspects and the trader and the members' perspective, I think was really insightful and gave a good balance to it. So I think that was really good. So and appreciate it. Was good attendance. So appreciate that, and thank you, Graham. So for me, it's thanks very much. And if there's nothing else, Graham, we can wish everybody a good rest of the day and a good forthcoming weekend.
Yeah, no, nothing else from me. Just we'll be sharing the video probably later on today once I've managed to edit it. But apart from that, yeah, nothing else. Thank you very much.
Okay, thanks everyone.
Thank you.
Yeah, thank you very much.
Thank you.
Take care. Bye.
Cheers, bye.